Welcome once again to the Customs GST Advisory channel of CustomsGST.com. We once again present a very interesting and trending topic in GST regime. Imagine this: you purchased genuine goods. You received a valid tax invoice. You paid the supplier along with GST. The invoice reflects in your GSTR to be. Everything appears perfectly compliant. But months later, the GST department issues you a notice demanding reversal of your input tax credit. Why? Because your supplier allegedly failed to deposit the tax. Now ask yourself, should an innocent buyer suffer for the supplier's default? This is one of the most controversial issues under Section 16(2)(c) of the CGST Act. Section 16(2)(c) says that input tax credit shall not be available unless the tax charged in respect of the supply has actually been paid to the government by the supplier. At first glance, the provision appears straightforward. But once we examine how GST actually works, a much deeper legal problem emerges. What is the practical difficulty under the GST system? Suppliers upload invoices through GSTR1. Recipients receive those invoices in GSTR2B. The recipient pays the supplier including GST. Everything looks perfectly valid, but here's the problem. The supplier never pays tax invoice by invoice. Instead, the supplier pays one consolidated tax liability through GSTR3B. So here's the critical question. How can the recipient ever know whether the tax relating to his particular invoice has actually been paid? This is where the statutory problem begins. Section 16(2)(c) speaks of the tax charged in respect of such supply. That language is invoice-specific. However, GST payment is not invoice-specific. It is period-specific. Suppose a supplier issues 100 invoices. Total GST liability is 50 lakh rupees. But the supplier pays only 45 lakh. Which invoices stand paid? Which invoices remain unpaid? The GST law does not answer this question. The GST portal does not answer it. The rules do not answer it. Imagine that Parliament enacts a law saying, you are entitled to a statutory benefit only if a particular fact exists. Now imagine something even more remarkable. The law never tells you how that fact can be verified. Nor does it create any legal mechanism for discovering whether that fact exists. Can such a statutory condition be uniformly applied? This question lies at the heart of Section 16(2)(c) of the CGST Act. Today, we are not discussing hardship. We are discussing something much deeper: the relationship between a substantive statutory condition and the machinery necessary to implement it. What exactly does Section 16(2)(c) require? Section 16(2)(c) provides that input tax credit shall not be available unless the tax charged in respect of such supply has actually been paid to the government. Notice the legislative choice of words. Not merely tax has been paid, but tax charged in respect of such supply. The language appears to connect the statutory condition with an individual supply. That is an invoice-level condition. But how is GST actually paid? This is where theory and administration diverge. Invoices are reported individually through GSTR1. Recipients see those invoices in GSTR2B. However, tax is not discharged invoice by invoice. The supplier files one consolidated GSTR3B. Tax is discharged through the electronic cash ledger, the electronic credit ledger, or both. The payment represents the supplier's aggregate tax liability for the return period. There is no statutory allocation of payment to individual invoices. This distinction is fundamental. The missing legal bridge: consider a supplier who issues 100 invoices. Total GST liability is 50 lakh rupees. The supplier ultimately pays only 45 lakh. Now ask the obvious question: which invoices stand paid? Invoice number 1, invoice number 50. Invoice number 100. The GST portal does not answer. The Act does not answer. The rules do not answer. No statutory provision attributes aggregate tax payment to individual invoices. Yet Section 16(2)(c) appears to require proof that tax relating to such supply has actually been paid. This is the structural tension. Does filing GSTR 3B solve the problem? Many taxpayers assume that filing GSTR 3B means the supplier has paid tax. Legally, that assumption is not always correct. Filing GSTR 3B demonstrates that the return has been furnished. It does not necessarily establish that the tax attributable to a particular invoice has been discharged. The supplier may have short paid tax, understated liability, claimed ineligible credit, or become liable after departmental audit. Therefore, GSTR 3B filing is evidence of compliance with the return requirement, not conclusive proof of invoice-specific tax payment. Rule 37A was introduced to deal with a specific situation. Where the supplier files GSTR 1 but fails to furnish GSTR 3B within the prescribed time, the recipient must reverse the credit. This rule undoubtedly creates machinery, but notice its limited scope. It addresses non-furnishing of GSTR 3B. It does not expressly deal with subsequent short payment, audit demands, adjudicated liability, revised liability, or other forms of supplier default. The machinery, therefore, remains partial. A deeper question of statutory interpretation, this discussion is not merely about tax administration. It concerns a fundamental principle of statutory interpretation. The Supreme Court has repeatedly held that substantive provisions and procedural machinery must operate harmoniously. Where Parliament creates a substantive right or obligation, the law ordinarily provides machinery for determining when that right arises, or when that obligation becomes enforceable. If the machinery is absent, courts strive to interpret the statute in a manner that preserves workability, although no Supreme Court judgment has yet decided this precise issue under Section 16(2)(c). Several established decisions provide interpretative guidance. In CIT versus B.C. Srinivasa Sethi, 1981, the court observed that where the charging provision and the computation machinery are so inextricably linked that one cannot operate without the other, the levy itself may become unworkable. The principle is broader than income tax. It recognizes that statutory provisions must have workable machinery. Inch. K.P. Varghese versus ITO 1981. The court rejected an interpretation that would produce arbitrary and unreasonable consequences where the statutory context suggested otherwise. The decision reinforces purposive interpretation over literalism when literal interpretation defeats legislative intent. In Ica Motors Limited versus Union of India, 1999, the Supreme Court recognized that input credit under the Modvat scheme constituted a valuable statutory right and could not be defeated except in accordance with law. While arising under the central excise regime, the judgment underlines the importance of certainty in credit mechanisms. Recently in Safari Retreats PVT, Limited. Although decided in a different context, the court emphasized that ITC forms an integral part of the GST framework and that statutory restrictions must be interpreted consistently with the scheme and object of the legislation. The issue there concerned blocked credit, not supplier default, but the decision demonstrates that ITC provisions should not be construed mechanically without regard to statutory purpose. Now comes the real constitutional question. Suppose two honest purchasers receive identical invoices. Both verify GSTR 2B. Both pay their suppliers. Both satisfy every requirement within their control. One supplier later defaults. The other does not. Can the entitlement of the recipient depend upon a fact which neither recipient has any statutory means of discovering? That raises an important issue under Article 14. Not because the provision is harsh, but because the law may operate differently upon persons who have acted identically, based upon information that is legally inaccessible to them. Perhaps the controversy is not whether Section 16(2)(c) is constitutional. Perhaps the controversy is whether the present statutory machinery is sufficient to implement it objectively. An invoice-specific substantive condition requires an objective mechanism for invoice-specific verification. If the statutory framework records only aggregate payment, the relationship between the legal condition and the administrative machinery becomes uncertain. That is the real debate. So the question before policymakers, courts, and taxpayers is not merely whether credit should be reversed. The deeper question is this: can Parliament require proof of invoice-specific payment while providing only an aggregate payment architecture? Until this question receives authoritative judicial determination, Section 16(2)(c) will continue to generate one of the most important debates in Indian GST law. According to recent media reports, the GST Council's Law Committee has approved a proposal to protect bona fide buyers from losing input tax credit due to supplier defaults. If approved by the GST Council and implemented through amendments, a genuine recipient who has received the invoice, reflected in GSTR 2B, and paid the invoice value including GST through banking channels, may no longer lose ITC merely because the supplier failed to deposit the tax. Instead, recovery may be pursued against the defaulting supplier. This proposal could significantly strengthen fairness, legal certainty, and ease of doing business under GST. However, remember, this is only a proposal. It is not yet the law. The existing provisions of the CGST Act continue to apply until the GST Council approves the proposal and the necessary statutory amendments are notified. Before we conclude, let's quickly recap the most important takeaway from today's discussion. Section 16(2)(c) should not be viewed merely as an issue of invoice-wise payment mapping. Where the supplier has correctly filed GSTR 1, correctly filed GSTR 3B, the aggregate tax liability matches, and the tax has been duly discharged, there is ordinarily no legal basis to allege that tax relating to a particular invoice has remained unpaid. The real challenge arises only when the department subsequently alleges a supplier default. At that stage, the law leaves several fundamental questions unanswered. When is the recipient expected to determine that a default has occurred? How will the recipient come to know of such default? Who is legally obliged to communicate that information? And what event actually triggers reversal of input tax credit under Section 41? Except for the limited situation covered by Rule 37A, there is no comprehensive statutory mechanism providing these answers. That is why the strongest legal issue is not invoice-wise payment mapping. It is the absence of a complete procedural machinery for implementing Section 41 in cases of alleged supplier default. Ultimately, tax law must operate with fairness, certainty, and legal predictability. A taxpayer's valuable input tax credit should not depend upon an undisclosed event or an uncertain procedure that the statute itself does not prescribe. If you found this legal analysis useful, please like this video, subscribe to the channel, and press the bell icon so you never miss our latest updates on GST, customs, and indirect tax law. Thank you for watching. Visit us at www.customsgsd.com for in-depth legal analysis, practical guidance, and the latest developments in indirect taxation. Know the law, protect your rights. Thank you, and I'll see you in the next video.